In this session, which will be our final session, we'll be covering Chapter 11, Personal Finance. Whenever you're talking about all of these concepts, especially if you're involved in a small business itself, whether you're the owner of the business or you're part of management or you're just an employee of the business, how all these things interrelate with a person's personal financial situation should also be taken into consideration. One of the terms that is used out there quite a bit is the term risk. And risk, just by its nature, is the uncertainty of future outcomes. There's two kinds of risks. There's the speculative risk, which is that a risk in which there is a possible gain or a loss. And this, of course, is uninsurable. If you go out and decide that you want to get insurance to cover potential gambling losses, you'll just get laughed right out of the insurance office. But there's also that which is called pure risk, which involves only a chance of loss or experiencing a theft or fire. And that kind of risk is virtually almost always insurable to some extent. And so what's the risk criteria for an insurable loss? Well, the potential losses must be reasonably predictable. The loss must be accidental, not intentional, or as a result of negligence. The loss should go beyond the control of the insured, and it should not be catastrophic to the insurance company itself. And so when an insurance company and you're trying to identify risk exposure, there are different kinds of risk exposure. There's marketing risk, credit risk, loss of service due to death or disability, and business interruption risk. So let's talk about just the management of risk itself. Because risk management, whether it's in your life or in your business, is performing the planning function in such a manner that will reduce some of the uncertainty of risk. And these methods include risk reduction, risk avoidance, risk transfer, risk assumption. So let's just talk through these kinds of methods itself. Risk reduction includes programs that reduce risk. Examples are sprinkler systems, giving up smoking, investing in government securities. A lot of initiatives that you will see in companies with respect to safety rules and programs are for risk reduction type of programs. There's also risk avoidance programs, is trying to avoid any hazard which exposes the business to risk. An example is a company deciding to have cash only rather than extending credit or any other kinds of transactions that may mean that you don't receive the full amount of that sale itself. Choosing to have a no smoking policy around flammable materials is risk avoidance. There's also risk transfer methodologies, which is transferring risk to another party, usually a factor or an insurance company. For example, transferring risk and deciding to factor your receivables is in essence transferring the risk that a receivable might go bad, transferring it to another party who's going to be responsible for collecting. That can be a very expensive kind of insurance, but it also can be an insurance. There's also risk assumption occurs when you believe that the loss you might incur is less than the cost of risk avoidance or risk transfer. For example, let's go back to factoring of receivables. You have decided through your credit policies and through your aggressive collection practices or however else you're going to manage your receivables, that to you recognize that some of those receivables are going to go bad, but you're willing to accept that rather than incur the cost of going out and factoring those receivables itself. So what are types of insurance you can get out there? Well, obviously, there's life insurance. This is for personal purposes. Life insurance is just the method of transferring risk from you to the insurance company. And there's two basic kinds. Term insurance, which is just as long as you're paying the premiums, it's just going to cover your insurance. You stop paying the premiums, that's the end of your insurance. There's also what's called permanent or whole life insurance, which in essence allows you to build what's called a cash surrender value, a cash value, into that policy itself that you could borrow against or that you can cash out at some point in time. And underlying that is also a life insurance that has a term aspect to it. I'm not going to go, there's a lot of information on these slides, a lot of information that down in detail that's really just talked about in the textbook itself. So I'm not going to go into a whole bunch of discussions on these things. Just understand that within the text, it really does go into much more detail, for example, on different kinds of whole life insurance. There's also health insurance, which obviously is used to alleviate the cost of an illness or other health problem. There's different kinds of insurance companies out there that insurance is provided through. HMOs, which will use their own doctors and specialists and networks and hospitals, and you have to stay within whatever their approved organization is. There's also PPOs, which may be an expanded network, but again, you've got those kinds of providers that you have to choose from. There's also private health insurance out there, which is more expensive. There is Medicare, which once you get above 65, is health insurance that can be provided if you don't have health insurance through an employer if you're still working. Medicare can also provide disability for at least 24 months out there. There is separate disability insurance outside of Medicare that can be purchased to replace lost income. There's long-term care insurance and other kinds of liability insurance. Again, I'm not going to spend a whole lot of time talking about this in detail. The personal finance class, BFIN265, actually on most of the subject matter within this chapter is actually gone into in much more detail within that class. One of the things to understand when you are talking about financial planning goals is especially with respect to personal goals, is you have to establish goals that are realistic and obtainable. Everybody would love to be a millionaire by the time they're 35, but that may not be a realistic goal for you. May not be an obtainable goal. But any sort of financial goals that you establish in your life must begin with the acquisition stage of a capital accumulation. In other words, you can't disregard any of those things and then all of a sudden decide that when I'm 60, I want to have $1 million in my retirement account when I'm 65, and use that to be the starting time of trying to accumulate that kind of retirement. So it's important that you understand that there is sacrifice, that there are costs associated with that capital accumulation, and the earlier you start in life, then the less you have to set aside on an annual basis to achieve whatever your financial goals are. You also, this capital accumulation, you preserve that capital accumulation by investing in vehicles that provide a return that is greater than the inflation rate. So if you decide that you're going to stick your money into a mattress, there's no returns there, or you're just going to stick it into a money market checking account that gets 0.5% at the most per year, but inflation is going at 1% or greater per year, you're actually losing out in the long run. Also, another thing to consider when you're setting financial goals is your own personal tolerance for risk. And that's an important aspect of really helping you to determine what you are going to put your investments in. Again, we talk about this much more in the personal finance class. And you also want to understand that capital that you're accumulating in, it really has two vehicles then of where it's going to go. A portion of it is going to go for retirement, and some of it may be also planning as to how to transfer your estate to like your children or grandchildren in the future. The primary vehicle that you are going to be involved in essence, in this capital accumulation is going to be investments. And so you're going to be looking at various investment vehicles, and we'll just talk briefly about these investment vehicles in a moment here. These investment vehicles, basically, as you go down the list, the risk and the reward gets greater and greater. And so this is where, when we talk about your own personal tolerance for risk, is really kind of helps to define how far down that list you may get involved in personal investments themselves. Cash equivalents, which is the most liquid of those assets, is anything that you're putting into savings account or money market accounts. And these can include treasuries, bankers' acceptances, CDs, and those kinds of things. As you move further down the list there, you start to see that there are bonds that are out there as an acceptable investment vehicle. And there's all sorts of different kinds of bonds: U.S. Treasury bonds, municipal bonds, corporate bonds. Let's just talk about those categories just briefly. U.S. Treasury bonds have different kinds there that usually have maturities that are usually in 3 or 6 month increments. T-bills themselves are usually mature in less than a year. T-notes go for much longer terms, and then there are bonds that can go from 10 years up to 30 years into the future themselves. There's municipal bonds. Again, cities and states will usually, or water districts or those kinds of things will usually issue these kinds of bonds. Quite often these bonds are exempt from taxes, so that helps to make them a higher return and something that should be considered. There's also corporate bonds, and depending upon the underlying strength of the company itself, really kind of tells you how risky or how safe this particular kind of bond investment is. From a terminology standpoint, if you hear the term secured bond, that means that there's some sort of assets that are underlying that. For example, if there's a bond issued for the construction of a plant, the plant itself might actually be pledged as collateral on the bond itself, so that if, for example, the company were to start to go bankrupt or start to have financial problems, the underlying asset is there to help to repay those bondholders themselves. A debenture is any sort of bond that is unsecured by a specific asset, but when in the event of a liquidation, they're going to get preferential treatment above stockholders themselves, but after the secured stockholders. Also, an investment in corporations is there's stock, common stock, which is again, you can purchase out there on stock exchanges. Common stockholders are considered to be owners of the corporation. They actually participate most of the time in voting for the board of directors, and a common stock itself may or may not pay a dividend. It's going to depend upon the company itself. It's going to depend on its history. Obviously, if there's a dividend paid out, it is factored into the value of the stock itself. Stock terminology that you will hear sometimes is you will hear the term par value. And par value is just an arbitrary amount that was established at the beginning of the company when the company was established. And usually it's something like $1 or $10 or $100. And it in and of itself doesn't really carry significance beyond what is recorded for accounting purposes. You will hear the term book value referred to in for stockholders' equity, and when you look at accounting for stockholders' equity, you will actually see that there are categories there on the balance sheet of stockholders' equity. Stock at par, and that's the par value. So if you have 1,000 shares at a dollar amount, the arbitrary amount that was established, that dollar amount is the accounting for that. That 1,000 shares times $1 will show up on the balance sheet at $1,000 at stock at par. And then any value that's put into the company, if that stock was actually sold for $10 a share, is the other $9. A dollar goes into par value, the other $9 goes into the additional paid-in capital. And retained earnings, of course, is primarily the accumulation of earnings and losses from the past history of the company as it's being carried forward in equity itself. Just again, to continue on the just the stock terminology, is there's this book value per share is sometimes you will hear that, and that is just referring to, again, the value of the underlying value from an accounting standpoint divided by the number of shares outstanding. Market value per share is really the number of shares that are outstanding times what it really is selling for out on stock exchanges out there. What are some factors that affect market value of a share of stock? It's just important to understand that if this is an investment vehicle, that it's sometimes the market value for a stock is going to depend upon the supply and demand for the shares of stock. It's going to depend upon the underlying financial strength of the company, the forecast for the future, and how bullish people feel about the future. It's going to have a tendency to be driven by some of the underlying value of the assets themselves, and of course sometimes just general economic conditions can drive some of those kinds of things. There's also a kind of stock out there called preferred stock. Preferred stock is that in essence, when you look at liquidation preferences in a company, the people who get if a company has to liquidate, the people who get their money first are the debt holders, and the secured debt holders and the unsecured debt holders. And then you get to preferred stockholders, usually will get their money next, and the common stockholders kind of get whatever the leftovers are. Preferred stockholders are considered to sort of be owners of the corporation, but they really have no voting rights. Usually, again, preferred stock there's all sorts of different kinds out there. And preferred stockholders, sometimes there are dividends, sometimes there are no dividends, sometimes they're convertible, have convertible features to common stock, sometimes they don't. It just varies from company to company. There are different kinds of preferred stocks. Some are cumulative, which when the corporation decides to pay a dividend, the preferred stockholders get their dividends first. And if they haven't been paid dividends in previous years because the company hasn't declared any dividends, a cumulative preferred stock means that the preferred stockholders get all their back dividends first before any common stockholders get theirs. Convertibility feature I mentioned before was convertibility to common stock. Also, sometimes there's a callable feature on it in that a company can have either certain triggers or they can decide to call back preferred stock. And of course, all of these things will impact the actual value of the stock itself. The dividend itself is any sort of payment, usually in cash, but it's paid out, but sometimes dividends can be paid in stock. And so whenever you hear something like a stock split, technically that is actually a stock dividend where they are giving out, for example, 2-for-1 is every share that's outstanding, they issue another share of stock to that stockholder. And there's all sorts of reasons in financial capitals and things like that as to why you might want to consider doing something like that. And we're not going to get into all that detail in this class. As you're moving down the list of investments, there's mutual funds, and there's all sorts of different kinds of mutual funds that you can get involved with. And these funds are growth funds, income funds, or sometimes what are called balanced funds. And growth funds usually are investing in common stock of companies that will have appreciation that may do better or do worse than the market in general, or even interest rates in general. Income funds are usually zeroing in on specific returns that come with interest rates type returns. Or sometimes there's balanced funds, which have a little bit of everything. There's also, as you move farther down the investment types, as you're increasing in risk, there's real estate, which can be an investment in land and buildings. Obviously, in real estate, there's an investment for you as a person who, when you invest in your primary residence, that's considered to be an owner-occupied real estate, and you're also allowed just definitionally by income tax law, you can have one additional vacation home that can also be considered a part of your primary residence. You can also be investing in non-owner-occupied real estate. You buy an apartment building, you buy a house to rent out, or you buy motels or other kinds of investments that in essence involve some sort of rental income stream. You can also get involved in commercial real estate by going out and buying office buildings, shopping centers, those kinds of things. You can also participate with some of the big boys sometimes by getting involved in trusts. And trusts, real estate investment trusts, will participate in large office buildings, shopping malls, real estate developments that are big real estate developments, just all sorts of things like that. Again, all of these are driven by the underlying value of whatever's happening within the real estate market itself. When you're talking about the riskiest type of investments, of course, precious metals and collectibles fall into those areas. And these are areas that, for the most part, as an individual, you really shouldn't get involved in these areas unless you really have some expertise in this area, or you have hooked up with somebody who has a great amount of expertise. Also, you have to be prepared to lose it all, or to lose a significant portion of it, because these kind of investments can really run the risk of having great appreciation or great losses. Whenever you're looking at these kind of investments, of course, there's short-term strategies and there's long-term strategies. Short-term strategies that the textbook talks about includes, you can even get involved in buying stock on margin or selling it short or option trading. Again, these are riskier type of transactions that, for the common man, I would suggest you just steer clear of, unless you really know what you're doing, because the potential for loss can be quite great. For long-term investment strategies, of course, you're going to be looking at whether you're investing in stocks or bonds, or what it is of buying and holding it and getting the appreciation, the return on the investment there itself. Also, an important consideration whenever you're looking at personal financial plans, of course, is in the whole pension planning area. And this can be quite a technical area, and quite a lot of options that are out there. And again, in BFIN265, personal finance, we get into this in much more detail, which really allows you to be able to make some decisions as to what is the best direction for you to go. But just to mention briefly, there's three main sources of retirement income out there. There's Social Security, which, by the way, was never intended by Congress to be the sole means of retirement income. And I know for a lot of seniors, it's becoming more and more, and that becomes problematic longer term. Another source of retirement income are retirement plans, employer sponsored, and also there's personal savings. Sometimes the personal savings are through employer sponsored retirement plans where you participate with the employer. Sometimes it may be something on the side when you're establishing your own investment vehicles and the annuities and all those, and 401ks and all those kinds of things. I mean, there's IRAs out there, individual retirement accounts, there's Roth IRAs, there's Coverdale education expenses, there's Section 529 expenses. There's all sorts of different kinds of plans that are out there. And these plans are contribution-oriented plans. Some of them are benefit-oriented plans called defined benefit plans. Some of them are a combination of the two. You really need to really be looking into what makes the most sense for these kinds of plans. Again, as I know I'm going through these slides kind of quickly, I have the slides on Moodle there, so you can go back and look at them more in detail. It's really a summarization of what's already found in the textbook itself. So as I go through here, you just recognize and see that there's all sorts of different kinds of plans that are out there. Plans that are, if you're part of a company, plans that you can set up separately as an individual, plans if you work for a nonprofit, plans if you're a small business, plans if you're partnerships, plans that could participate in the profit of a company, plans that the employer is contributing to and you're contributing to. I mean, all sorts of different kinds of plans. And as you go through, again, these plans will have different risk reward relationships. They'll impact you differently in the pocketbook, and they'll impact you differently as you go through your career, as you change from company to company, and options that you have or you don't have anymore. So whenever you talk about retirement strategies itself, it's just important to establish a goal or a minimum income level that you desire when you retire. For example, a lot of people throw out $1 million. Do you really need to have $1 million to retire? Well, the answer to that is it depends. It depends what you want to do in retirement. If you want to be traveling the world and you want to be have all sorts of expenses associated out there, and you want to buy multiple houses so that you can be snowbirds or whatever, the answer may be yes. Um, the answer may be no. I'm going to settle down. I'm going to relocate to be close to grandkids or my kids, and I'm going to find a little place, and I'm going to live. I'm going to downsize. You may find that you don't need to have $1 million. So again, it's what are your own personal plans itself. Do not wait. The longer you wait to start to set aside for retirement, the harder it is to achieve your goals that you set into place. One of the mistakes, especially younger adults make in their 20s and 30s, is they say either they can't afford to start to set something aside because all their money's going towards kids and houses and cars and et cetera, et cetera. Don't wait. You don't have to necessarily start off big, but you want to get in the habit of establishing something up front. As you begin to accumulate funds, and the larger those funds get, then you're going to want to make sure that you do the kinds of things that preserve the capital of those funds and the continued growth of those funds, which means that you're going to have different perspectives, different views. And as you age and as you progress in your career and your income stream, you're going to be allocating those kinds of funds differently. So that's why your own personal risk tolerance becomes quite important. So it's again, there's many considerations to take into account here. Last thing is, and again, this is all covered in BFIN205 personal finance, is just there's understanding estate planning. Is if you have your own company, how do you plan on passing that company on? In essence, an exit strategy. If you have an estate that needs to be protected from taxes, there are important considerations to take into account. There's considerations with respect to how you might start to distribute the estate, even while you're still alive. You're going to want to understand the role of wills and making sure that you're adequately covered there, so whatever your desires are, it will be carried out according to your wishes. Understanding that as you accumulate funds, that you may want to use trusts, and there's all sorts of different kinds of trusts out there. And again, the personal finance class goes into this in more detail itself. So as we close out this chapter, hopefully you get an understanding that when we talk about the whole area of business finance, that this has tentacles that go into our personal lives, our business lives, our lives as employees, and that is this class hopefully has just really kind of scratched the surface with respect to giving you a better understanding for what is out there with respect to terminology, definitions, and even with respect to just basic analysis of a company itself. Hope you have enjoy the rest of your time off after this semester. Until later.